The last section we're going to be looking at here for when traders make bad entries is missed indicators. And that's when you focus too much on one little aspect of the chart, make it, let's say, a key moving average resistance. We close above it, making me want to enter bullish, but I forget to look at all the other indicators, the RSI, the MACD, and also other time frames, daily, weekly, hourly, and 5-minute time frames. Of course, that depends on your outlook. If you are a long-term investor, you're looking at the daily, weekly, monthly. If you're a day trader, you're looking at the 5-minute, the daily, and the hourly. And so that can change depending on what your perspective is. But you need to analyze all the pieces of the puzzle. One little piece going in your favor is not enough to enter a trade. Is the price extended in your direction? And what I mean by that is, let's say I'm day trading and I've got the 5-minute chart and I'm looking for a close above the 200 period 5-minute resistance. And leading up to that resistance, we see 30 minutes of green in a row. 6 green candlesticks, very little to no consolidation, and then we close above that resistance level. That's what I was looking for, that signal, but the fact that we just saw six candlesticks in a row with no consolidation to the upside, that might make me hesitate on that bullish entry because I know consolidation is likely to be coming in the near-term future, and the risk to reward of that entry changes due to the price action leading up to that resistance. Is there room to move before the next resistance or support, depending on the direction? So let's say I'm a bear, and I want to make a bearish entry once we lose the 200-day moving average support. So we look, and the day closes below the 200-day moving average support. So there's my signal to make a swing entry, and then I need to look at the weekly time frame. What if the weekly time frame has a really strong support, just a few pennies, just a small move down below that 200-day moving average support? So that tells me that the bears are not out of the woods yet. We still have another key level to be watching, and I might not want to make that bearish entry just because I got my daily signal, because the weekly signal still has a very key support. So again, that goes back to looking at all different kinds of time frames and establishing if there is room before the next clear resistance or support level. And all of this, patience and confidence is key. You don't want to be just looking and focusing in on one little aspect. You need the bigger picture. And what I want to be the takeaway from this is having a fear of missing out on a move is something that you want to work to conquer. The last thing that you want to do is be entering a trade because you don't want to miss profits. I would not absolutely every time miss a bullish move because I didn't see a setup that I wanted. That's fine with me. I lost $0. I made $0, but I didn't fit the formula that I was looking for. I didn't have the confidence that I was looking for on that trade. So I say, oh well, better luck next time. I look at what I could have learned from that trade. What were the signals that maybe I'll catch next time? But I don't get caught up on the missed opportunity. I go and look for the next one, and I know that I lost $0. So patience and confidence is key. And the takeaway, again, looking at all different kinds of time frames, looking at all the pieces of the puzzles, all your different indicators, and then making an informed decision using all those little pieces of the puzzle to get a clear, bigger picture. Now let's look at our last example of the lesson for some missed indicators. So for this last example, we're going to be looking at Apple. Now the setup for Apple on the daily time frame was a very bullish move to the upside. We have a 3-gap up bearish reversal pattern. There's two schools of thoughts on gaps. Some people say that the wicks fill the gaps. Other people say that it has to be the real bodies of the candlesticks overlapping. So for this example, we will take the school of thought of the real bodies. So we'll say this is a bearish 3-gap up reversal pattern, topped off with a bearish reversal, spinning top, confirm the next day. So we know a pullback is coming. We are seeing the RSI just hit 70, a little overbought, consolidating, normal healthy consolidation after a breakout. So we established a base of support at 112.44 here. That was the low. Then we bounced and established a lower high, and that was up at 114.94. Now, a clue that we were not going to continue heading higher and break out to the upside was volume. You can see steady declining volume, and that day where we had that bullish little gap up did not have the bullish volume to back up a powerful move to the upside. So we see ourselves setting a lower high, and now the bears are going to be looking for a lower low to form, and ideally a loss of this 10-day moving average support. So that support again was 112.44, the previous consolidation low, and we did break it on this day, and we also broke the 10-day moving average support. So there's a lesson in waiting for the candlestick to close on the daily. We were well below that 10-day moving average support. The bulls bought the dip by the end of the day and closed above it, but that's not what we're going to look at here on this example. We're going to look at utilizing the different time frames and not missing key indicators. So if I was just looking at the daily time frame, let's say I'm working and I'm in the office and I pull up the daily chart, I see a big red candlestick, the price is down here, breaking 112.44. That could be my bearish signal for an entry, and let's say I made a bearish entry looking at that daily time frame, and then by the end of the day I am down a little bit because the bulls bought that dip. How could I have known that the bulls were going to bounce? Well, you just need to look at shorter term time frames and get every piece of the puzzle. Here's the 5-minute chart. Look at this insane dump. It absolutely fell off a cliff. The RSI on the 5-minute got down to 6. Extreme oversold. You see the RSI on 6 on the 5-minute time frame, you know to be looking for a bounce. So that level was 112.44, and by the time we hit 112.44 and broke it, that was on the last red candlestick on this 5-minute dip, and it occurred here. Let's say I make my bearish entry looking at that daily time frame, and I think I'm hot stuff, very confident as we continue to head down. Little do I know the 5-minute RSI is under 10, and we are going to see an oversold bounce, and that's exactly what played out. Bullish reversal candlestick confirmed. RSI starts cooling off, higher lows and higher highs on the bounce. Next thing I know, I am in a hole. I'm down a little bit of money because I am a bear looking at that break of the key daily moving average support and daily previous price history support, but not seeing that it was coming on a very oversold dump that was very likely for a bounce to play out. So looking at the daily, looking at the 5-minute, understanding what's going on, you can see it was a big red day, but this candlestick doesn't tell you that all of that red pretty much happened within a half an hour time frame on the 5-minute. So getting all the pieces of the puzzle, clear view of what to look for, making the ideal bullish and bearish entries.